I want to start with numbers. 326 trillion shillings, 326 trillion shillings. That's how much money moved through Uganda's mobile money system in 2024 alone. Not banks, mobile money. And yet, despite that number, despite the fact that 64% of Ugandan adults use mobile money while only 14% use banks, the people moving that money are still being taxed in ways that are pushing them back towards cash. So today, I want to ask a real question. Why is the system that's actually working being made more expensive than the system that isn't?
Tax on all mobile money transactions to commercial banks.
Mobile money markets.
Let's put some numbers on the table, real ones. Fact 1. The size of the problem. Uganda has 43 million registered mobile money accounts. The entire country has about 48 million people. That means mobile money has reached nearly every adult. Fact 2. Who is doing what? 64% of adults use mobile money. Only 14% use a bank account. And yet, mobile money users pay a transaction tax. Bank users most do not. Fact number 3. With number 3, the cost right now. Sending and withdrawing 1 million shillings cost more than 20,000 shillings in the fees and tax. Physically transporting that same cash between Kampala suburbs, less than 5,000. We have built a digital system that is more expensive than working with cash. That is not an accident, that is a policy failure. To understand why, we have to go back in the beginning. The banks in Africa were not built for Africans. They were built to serve colonial administrations and foreign trading companies, moving government fund, financing export, not serving the humans selling tomatoes in Nakasero market. Because they only serve the elite, they needed expensive physical branches in every city, and expensive branches needed revenue to run. So, banks took deposits from customers, lent that money to others at a higher interest rate, and kept the difference. That's still the core business model today. An infrastructure built for colonial administration, now wearing a digital interface. But here's where it gets deliberate. Banks wanted more deposits. More deposits meant more money to lend. More lending meant more profit. So they started offering free accounts to attract everyone, like students, low-income workers, small traders. But those customers had small balances. Small balances meant the bank couldn't lend profitably. So what do? They introduced fees, monthly services charges, withdrawal penalties, transfer costs, not to cover real costs, but to make the accounts of low-income customers too expensive to maintain. Researchers call this an exclusion tax, a financial fence designed to keep out the people the system was never built to serve. And then it became profitable on its own, so they kept it. Here's the proof that these fees are not necessary. We have Revolut, Wise, PayPal. If you send money within the same app in Europe, the fee is 0. Instant, free, and done. Revolut's annual revenue is larger than the GDP of some African nations. They are profitable without charging users to move their own money. In Uganda, my bank, DFCU, charges me when I use the app, charges me to withdraw to mobile money, charges me a monthly service fee, and then the government adds a tax on top. The fee are not a technical necessity. They are a choice. And in Uganda, that choice is being made against the people who can least afford it. Now here's the part of this story that gives me genuine hope. Because in 2007, someone decided the old system wasn't worth fixing. A microfinance company in Kenya called Safaricom was issuing small loans via SMS. Then they noticed something. People weren't just using the loans. They were using the system to send money to each other. Before this, sending money to your family in the village meant one of the two things. Give it to someone on a bus and hope it arrives, or travel yourself and come back the next day. That was the infrastructure of financial transfer in East Africa. M-Pesa looked at that system and said, what if we just did this on the phone? And just like that, mobile money was born. Now, but here's what almost stopped it. The public didn't trust it. Sending money or send money on a phone, that's a scam. The bank fought it hard. They saw mobile money as a direct threat to their deposit base, and governments had no framework for it. In this, a telecom product or a financial product, who regulates it? The central bank or the telecom authority? In Uganda, that question is still being answered, but the people voted with their phones. They adapted to it anyway because it worked and it was fast, and it didn't ask them to stand in a queue for 2 hours. After Kenya, Uganda launched mobile money. Then Ghana, Tanzania, Rwanda. Now mobile money is available in 30 African countries. Sub-Saharan Africa now has more than 1 billion registered mobile money accounts. That is nearly 50% of the global total. $2.5 billion in transactions processed every single day. According to the GSMA 2025 State of the Industry Report, Africa is the undisputed global leader in mobile money. The continent that was told it was behind built the world's most advanced mass market payment infrastructure on a feature phone and a SIM card. That is not a small thing.